Boom! What's going on, Investomaniacs? Your boy, Knight Rider here, back better than ever, fresh from a San Diego vacation, got a little sunshine, not that you can see from my face, because I always got that sunscreen all over, making sure I stay nice and pasty white. My dad got a boat, that was kind of cool. I checked out my old stomping grounds where I used to grow up, so I posted that video, you guys saw that, and boy, have the markets turned a little bit sour in the couple days since I went on vacation. The Dow Jones is down 2.9% today, S&P 500 down almost 3% today, and the NASDAQ down almost 3.5% today. Bitcoin actually popped 7%. It's like the new gold, going the opposite directions of all these U.S. stocks, and the 10-year U.S. Treasury is now down to 1.718% after that 0.25% rate cut. Whew. But boy, if you owned stocks, U.S. stocks, this was a rough day for you. Stocks suffered their worst day of the year as the U.S.-China trade war just erupted on a whole new front, the currency battle. Stocks plummeted because of China's dramatic currency move. Governments worldwide let the free market determine how much their currency is worth, how much their dollar, their peso, real, pound, or euro through supply and demand. For example, Europe, if they're buying some fancy American corn, they need to sell euros to buy dollars. That's supply and demand. Or if you go to, say you go to an airport and you always see that currency exchange board and the number is always constantly changing, that's because it's a live system. It's always moving with supply and demand, how much your currency is worth. But China's government does it a little bit differently. China simply dictates how much its currency is worth. So this happened on Monday. Here's what China did. The government is weakening its currency so that your $1 US now buys a whopping 7 Chinese dollars. That's the weakest level the currency has hit in over a decade. When President Trump keeps saying China devalues their currency, this is exactly what he is talking about. What did the U.S. do? It called China out. The Treasury Department labeled China a currency manipulator, a naughty list the country hasn't been on since 1994. Currency manipulation is tariff kryptonite. China just opened a whole new front in the trade war because this move partially neutralizes U.S. tariffs. It's an intense escalation, but it's classic trade war tit for tat. Here's how it went down. Last week, the trade deal talks in Shanghai did not end well. The United States pledged a 10% tariff on the remaining $300 billion in Chinese goods not yet tariffed, mainly consumer goods you use like toys and tech stuff. Since tariffs are like taxes, that would make Chinese-produced products, including the Chinese-produced iPhones, 10% more expensive to Americans. That's right. Apple is an American company, but you're now going to have to pay 10% more through the tariff to buy an iPhone relative to, say, a Samsung Galaxy, which isn't even an American company. But that's what happens under a Trump administration when you produce your products in China. If Apple eats this expense, it will massively impact the bottom line, which will in turn hurt the stock. If they pass the expense onto the consumer, less people will buy iPhones and instead opt for, say, those Samsung Galaxy phones or other alternatives. Either way, this is horrible news for Apple, and it may get even worse, potentially significantly worse, if that tariff increases to 25%, which is a very real possibility. So, by weakening the value of their currency compared to the US dollar, China offsets part of the tariff's impact. Here's the takeaway. Nobody really wins in this trade war. At first, the US tariffs hurt China by making it more expensive to manufacture inside the Great Wall, encouraging United States companies like Apple to make stuff elsewhere, preferably in the US. That's why Trump has lowered taxes and deregulated, and a fair number of those companies are bringing manufacturing jobs back to America, or at least they're leaving China. Now, China's currency manipulation hurts American companies because their Chinese competition has suddenly become cheaper for customers to buy. That's right, because our US dollar is now stronger in China. We can exchange it for more Chinese dollars, so that then again makes Chinese manufacturing cheaper. Trade wars are races to the bottom. Welcome to the new front. This trade war is getting nasty, which is why I still recommend investing in companies with little Chinese exposure. That includes, at least for the time being, avoiding Apple until this is resolved. Up next, SHAK stock jumps to its highest point in over a year and pulls a delivery 180 with a GrubHub partnership. SHAK shares were already up 60% year to date. They just rose even higher as the chain spreads its caloric gospel worldwide. It's raising revenue expectations in Shanghai and Hong Kong, just opened operations in Mexico, and has new shops ready for the Philippines and Singapore. But check out these other earnings report highlights. SHAK always hated delivery. That policy has led to brutal lines. The Madison Square Park original location literally has a live cam so you can check out how long their line is. For years, SHAK insisted your shroom burger and fries must be eaten on site. Here's what the CEO even said last year. Burgers were, quote, not intended to be eaten half an hour after they were cooked. And delivery didn't, quote, necessarily fit really well with the brand. But wait. Update, SHAK just announced in its earnings that it's partnering up with GrubHub for delivery at 150 locations over the next 9 months. By the way, it was a solid quarter. We can see same-store sales up 3.6%. Overall, total revenue up 31%, although a lot of that is just due to expansion. There were 19 new domestic locations opened up in the quarter. The takeaway, we are at the pinnacle of the food delivery wars, with some startups consolidating, but this SHAK update is a perfect example of exclusivity. Taco Bell is now exclusive with GrubHub. McDonald's is committed to Uber Eats and DoorDash. SHAK tested delivery with Postmates, but ultimately landed with GrubHub. Exclusivity is an important factor for these delivery companies to succeed. But does that mean you should be invested? Not right now. The delivery space has too much competition. It's too hot. And the overall space is losing a massive amount of money. But what about SHAK? I like the company. It was a good quarter, but the darn stock is just too expensive right now. If we get a decent-sized pullback, then we can talk. Up next, Tyson Meats and the great chicken pricing debacle of 2019. Planet Earth's second biggest, quote, processor of chicken, pork, and beef enjoyed a healthy quarter. Tyson's sales rose 8% and profits surged 25%. Nice. So the stock popped 5%. One issue. Tyson was also accused of a giant meat price conspiracy that may have affected your summer barbecue game. One serving of subpoena from the Justice Department, please. Apparently, it's not just the big tech companies being bothered these days. Tyson's biggest clients have had some concerns about chicken prices. They rose 11% from 2012 to 2018. Walmart makes up 17% of Tyson's revenues, and Olive Garden is another big buyer. But they and some others got skeptical. The accusation: Tyson and other chicken producers colluded, which is illegal, to prop up prices by limiting chicken breeding. Tyson, of course, denies it. The culprits: Tyson, Purdue, Pilgrim's Pride, and other chicken producers. The subpoena: the Justice Department is forcing Tyson to hand over any, quote, documents and information related to the chicken industry. Well, that's kind of ambiguous. That's going to be a lot of documents, ain't it? But hey, sounds official to me. The takeaway: cartels are hard. That's when companies work together. That's a cartel. You know, they kind of meet a couple times, they do a little wink, wink, and make moves that keep prices artificially high. It's anti-competitive, anti-consumer, and illegal. But it's also challenging to pull off and can be challenging to prove. It requires the backdoor coordination of a handful of key executives from several major players, which each employ thousands of people, and they need to coordinate this all together. It requires significant trust, as one single person from one competitor wearing a wire could cost you your cushy multi-million-dollar per year job. It's risky to do in the US, and perhaps that's why the most famous cartel isn't in the US. It's OPEC. We've all heard of that, the international organization of 14 oil countries which control oil supplies so they can control oil prices. This was a solid quarter for Tyson, but the long-term story just isn't juicy enough to get me interested. The company has virtually no top-line growth after inflation. If you're going to go with a no-growth company, at least in terms of the top line, I want you earning more than 1.88% on your dividend. Hey guys, that's it for today's video. Let me know what your thoughts are, or if there are any other stocks you'd like me to check out. I appreciate all the likes, comments, and support. Thank you so much, and please make sure you're subscribed to Investomania, brother.